Hello, this is Brian Beaulieu, CEO and Chief Economist of ITR Economics. Thank you for another edition of joining us for another edition of Trends Talk. Today I wanted to talk about our current hot topic, inflation. It is spiking in the latest data at the CPI level, both core and overall CPI. But there's a disconnect between what that's showing and what a lot of companies are feeling in terms of commodity price increases. And that has them scratching their head a little bit. But you have to remember that there's a difference between B2B pricing and how much of that increase in material cost and labor costs, for that matter, is actually getting pushed through to the consumer. And the CPI isn't going to show all the inflation that's out there. For instance, it doesn't show housing prices and what they're going through, at least not very well. So it's an imperfect gauge. And from our view, current rising trend in the CPI is likely to be transitory. We're going to see commodity prices leveling off. So that's going to help with the transient nature of it. Certainly the Federal Reserve thinks it's transitory because they're not raising interest rates. The bond market, our read on the bond market says that it is just our spike and it's going to be coming back down. And if we use rate of change all the time, and our rate of change analysis, you look at gold and that rate of change is coming down. You look at the money supply, that rate of change is coming down. All of which is a harbinger of diminishing or slower mitigated inflation in these late this year and certainly in 2022, likely going into 2023. So the rest of the story on inflation, however, is that that next low in the CPI isn't likely to be as low as the last three business cycles. And that's important. The last three business cycles, we saw our rate of change low vary between essentially 0 and 1.5%. This forthcoming low after this spike looks like a CPI bottoming out around 2.0% and then starting to rise from there. When you see, or if that happens, and you see it happen that way, that's going to be telling you that the next round of inflation is going to be more systemic, it's going to be broader, and it's going to be the beginning of the inflationary fires that have been lit by labor shortage. By the systemic deluge of fiat currency complements of the Federal Reserve, by their weakening US dollar. And that last point is important, by the way. Oil prices are going up, for instance, and they're going to continue to generally rise. There'll be a plateau at about $75, $77 a barrel, but clearly that's inflation until we hit that plateau. And then from there, the next rising trend in oil is going to be not coming from $40 or $50, it's going to be coming from something more akin to $60, $65. See, everything's starting at a higher base next time. So prices aren't correcting downward. We're not going to see the CPI correcting downward. And that's complements of deficit spending. At the end of the day, when people say deficit spending doesn't matter, it doesn't matter today. I get that. But it's going to matter down the road. We're laying the foundation for a higher rate of inflation, for even higher prices down the road, because they are fundamentally eroding the value of the dollar. The linkage is real. The correlations are real. And it's going to be with us for a long time. So we need to start thinking about how we are going to be protecting ourselves from inflation. Fortunately, been in this game a long time. Been able to impart a lot of knowledge, wisdom to the team. There are ways to cope with this inflation, but it's not immediate. It's not in 2022. So we have time to talk about it, and we will in a future Trends Talk. Thank you very much for joining me today. Brian Beaulieu, ITR Economics. Have a good one.